Okay, hi everyone. This is going to be the video for the TBS here. Essentially, what do we have going on here, right? They're giving us sort of the information up front. We have to populate these boxes down here. To help us do that, they give us some associated work papers that we have to look at. Now, it says here that Stephen and Beth Smith, right, husband and wife, they have asked you to prepare their year 5 1040. That's great. They're married. It looks like they have 2 children here that they're supporting, Terry and Madison. In year 5, they will take the standard deduction. They also took the standard deduction in year 4 on there. They give us some exhibits, right? And they say, hey, based on these exhibits, can you please fill in, pretend we're doing the 1040 and enter the income items down below, things like wages, interest, dividend, state income taxes, gambling income. Now to do this, right, we have to look at the documents, apply the rules. Let's start here with the client letter, right? It says, dear tax return preparer, I've enclosed the following information, right? So they're giving us some W-2s, some 1099s, right? One for interest, one for a brokerage account, a W-2G for some gambling winnings, a 1099-G for a state income tax refund, and then another W-2 for one of their daughters, right? So with that, right, let's look at the first line item here, right? Wages, salaries, and tips. The facts indicate that, hey, we should have 3 W-2s. So we would go to that exhibit on there, right? We would click the exhibit. It looks like we have one for husband, we have one for wife, and then we have one for daughter, right? Now, as a starting point, right, we're going to want to ignore daughter's income in the sense she will file her own tax return. But we are and have to include the income from the husband, the $75,000, plus from the wife, right, the $32,000 on there. So if we were to kind of do that over to the side here, right, we have 75 for husband, 32 for wife, right? We add those together, we're looking at 107 in wages on there. Next, right, we have to consider the interest income, right? So they're telling us here, hey, I have given you a 1099 INT as well as a 1099 consolidated on there. So looking at the 1099 INT, that's great, right? It looks like this is from a bank. There's $100 of interest income and then $50 of interest income from savings bonds, Series EE. Nothing in the facts indicates that we've used these for educational purposes. We're just going to assume that they are taxable on there. Likewise, right, we have the consolidated 1099, right? These are big guys. These are big. They include a 1099 dividend, a 1099 INT. You can also see brokerage transactions on there. We are focusing on the interest income for right now, right? We're trying to get that box. Hey, they're telling us we have $120 and then, oh, we have tax exempt interest of $200. That is going to be a trick, right? That would be like municipal bond interest income or something like that where it's not taxable. Accordingly, right, if we were to take the 100 plus the 50 plus the 120, right, so we'll put that off to the side, 100 plus 150 plus, let's see, the third amount on there, 120. Just sum those up. Hey, we're looking at 370 for taxable interest income. Next up, dividends, right? We're going to look at this 1099 consolidated on there. This time, however, right, we're going to look over at the dividends portion. Hey, they're telling us that we have $3,400 of dividends. That's great. And of that amount, 3,400, all of them are going to be qualified dividends. That is to say, they'll receive that special tax rate. A trick though, right? They're throwing in non-dividend distributions. Hey, those aren't dividends. Those aren't going to be taxable to us. Those are like a return of capital. If we wanted to break it out, that $3,400 a little bit more over here, they'll show you how much is domestic versus how much is foreign. However, considering we tax worldwide income, all of that amount, $3,400, is going to be taxable on there. So let's enter that guy in right here, $3,400. Next up, right, taxable refund of state income taxes, right? So what this is saying is, hey, we got this 1099-G, right? We must have had $60 of a refund from our state, Pennsylvania, income tax. Is this going to be taxable in the current year? Well, it depends, right? Did we receive a benefit from this? If you were to look in and dig into the details, well, hey, last year we took the standard deduction. Accordingly, because we did that last year, we took the standard deduction, we're not going to, and we aren't going to experience any income from this Pennsylvania income tax refund. Accordingly, right, we're going to put a 0 in there for this, right? So yes, we got the refund. However, because last year we took the standard deduction, we didn't really get a benefit from this. We were applying that tax benefit rule on there. Finally, right, we have gambling income, right? They tell us over here, hey, we went to the casino, we got a lot of winnings on there, and then we also had some losses, right? So what were our winnings on there? Hey, we won $5,000. That's great. That's awesome. We know that we have to include this in income. The question here really becomes, can we take advantage of these losses, right? The losses over here. Well, two-part rule, right? That is to say, you can only take the losses if you itemize, and when you take the losses, you can take them up to your income. In other words, you can't create an NOL with this. Applying this to the given fact set, right, we know in the current year we are taking the standard deduction. That is to say, we are not itemizing. Accordingly, if we're not itemizing, we don't get to utilize those losses. We can kiss them goodbye on there. So with that, right, we're going to have to, in this case, include the $5,000 of income on there, but we don't get any of those losses. So that will be it for the presentation here. Thank you very much. And we will go from there.